Okay, we're live.
All right. Hey folks, here again to talk a little bit about the markets. Last week we talked a little bit about the 10% pullback in the market, and we wanted to get a little technical on what this meant for investors, um, and talk through the four-step bottoming process that it's involved in the market right now and kind of where we're at. We'll try to keep this to 10 minutes or under. I know the last video was a little longer, but yeah, let's go to the next slide, Nick. Obviously, a lot of the information we use is with Ned Davis Research. Ned started in the 80s, was one of the first folks to actually put data into computer systems and analyze that data against markets. We think this source of information they give us is pretty reliable, but don't take anything today as a buy or sell recommendation. Obviously, have a conversation with your specific wealth advisor to make sure that any decisions you make sense in your overall plan. So, want to start off with a little bit of backdrop of kind of where we're at today. And you'll see a lot of different colors here. I am colorblind, but tried to highlight these so that it'd be easier to see. And what you'll see here is that, first and foremost, this isn't a sell everything everywhere type of pullback in the market. As you can see on the screen, that yellow line indicates the overall bond market through the aggregate bond, and bonds are actually up. They're doing what they're supposed to do right now. That orange line actually shows the value stocks within the S&P 500. Value stocks have come back off their high this year, but still up for the year. What you'll see there, though, is that the overall stock market or the overall large cap index is down 3.8% year to date. But really, where we're seeing most of the volatility is in the growth side of the market. These are some of the companies that have had, the most gains, you could say, over the last 2 years. And even though 7.8% seems like a lot, based on the last 2 years, it in hindsight, it really isn't that much of a pullback. Still is a pullback. So today we're going to talk about the four-step bottoming process in a market pullback, and you can see here mid-February we started to see the S&P 500 pull back and go in the downward trend. Around March 10th, there, if you can see on the bottom of the screen, the market seemed to have, yeah, there you go. Thanks, Nick. It seems to have at least started to rally from there. And today we've come off that pullback from about a week ago, and we're figuring it out. We're retesting our pricing here, and so we're going to talk through kind of where everything fits, where we're at, what charts to look at. Before we go to the next slide, Nick, you got any other commentary on this one?
Yeah, this is just, this is a more technical analysis of the market, but the technicals kind of show the real-time assessment of what's going on from an investor perspective, and that kind of shows us the conviction of the market. So this four-step process has been very, very successful in the past of knowing when there's at least an all clear or a runway for a sustainable rally. And so that's kind of what we wanted to go through today. And we'll keep it high level, but these are things that we're looking at overall to give us more of an all clear, because that's what questions we're getting. Like when do you want to get into this market? I mean, everything's at a discount from where it was before, but is that going to go down further, or can we feel convicted that we're going to have a sustainable rally?
All right, let's go on to the next slide. So, just for the record, I was in charge of visuals and Nick was in charge of putting forth technical information out here. So, we'll talk about the first step, and this is, that mid-February to mid-March move, and that was a pretty wild move. In fact, our daily sentiment chart actually went as low as it was during COVID. So, maybe talk a little bit about the characteristics of a oversold market.
Yeah, I mean, this was kind of a waterfall decline. I think it took 16 days to go down 10% overall. So this is step one of what happens in an entrenched downturn. The first thing, usually there is a oversold condition. The market goes down really fast, really quick. That leads to very, very high pessimism, which sets up eventually uh, buyers coming in, right? But the interesting thing about the sell-off, it was quick, but it was fairly orderly. Usually, when we see a panic sell-off or capitulation, VIX goes over. That's a volatility index goes over a certain level. I think it's 28.5. We didn't get that. It wasn't a complete capitulation of selling everything off. It was more of a rotation into low beta positions and value positions, and even international as maybe a hedge against the political uncertainty. And usually we have these indicators of really extreme selling of 10 to 1 declining volume over advancing volume. So we didn't have any of that in the sell-off that occurred here.
All right, so step one of the four-step bottoming process, obviously oversold in that analogy of kind of slipping and sliding down a hill. Step two, you've gotten up and you're starting to trek up the hill again, and that's the rally. And although we haven't necessarily seen extreme optimism in the short term or intermediate sentiment areas. We did see the markets pick up off those lows and head into new territory. But maybe talk through the characteristics you see here in step two, or that we've gone through already, and what that means for the future.
Yeah, so the extreme pessimism, the people that have sold have pretty much already sold, and there are bargain hunters looking in, dip buyers to get into the market, and short covering that happens as well upon rallies. And usually those short covering rallies only last a couple days. But this is a common occurrence. So after an oversold condition, we have these rallies overall, and sometimes they trick people. And this is the chance for people that wanted to sell the first time to sell the second time. And so there's going to be downward pressure probably back on the market. Usually we don't just have a V-shaped recovery. This giving me flashbacks. I've gone through these steps in 2020 during COVID. I went through these steps in 2022 with the declines, and they proved to be very, very successful. However, in COVID, we just went from sell off to rally because there was intervention at that time, which I don't think there's going to be extreme intervention like we had COVID. So we're going to have to go through a more normal bottoming process. Generally, in these rallies, we have really strong conviction of 10 to 1 up days, advancing volume over declining volume. We got that the day after our last video when we hit, I think, the 10% correction territory. I want to say March 14th. It was a Friday. I remember we had like a 14 to 1 up day. And so those are really broad convictions that we call them breath thrust indicators. But just one on them on its own is generally not enough to avoid step 3 and step 4, which is a retest and then potentially an all clear.
Good deal. Step three. So, yeah, so we bounced up, and we're actually kind of at this step three time frame here. You kind of talked through this a little bit as far as the second chance to sell. Um, talk to us a little bit about the characteristics here in this retest, and what's going to help lead us to step four, which would be getting back to new highs versus starting the process over again.
Yeah, so we're kind of stuck between step 2 and step 3. I wouldn't say that we have uh, a, a convicting retest. March 18th was our closest retest. But on basically after rallies, we're going to have down days, and we'll probably have significant down days. But successful retests include on those down days, we have less total volume, less downside volume, less percentage of stocks making new lows, and basically less pressure overall on down days versus the first kind of waterfall decline overall. So it's completely normal to go right back to our support or go near our support, but we want to hold somewhere near that support. And if we don't, then basically this process starts over again. We go back to step one, an oversold condition, step two, rally, step three, retest. But right now we're at step two and step three, and there has not been any kind of failed retest at this point in time. Um,
Yeah, I mean, step four is really my favorite here, and I think
yeah, I like
if
step
you
four as well.
yeah, let's go to next slide here. So obviously you can see there from the picture, step three, it's where we're kind of between two and three. At three, you're trying to get your footing as you head back up the hill. Step four is the result of finding your footing and continue to go higher and reaching a new high. Believe it or not, if we had a chart of the stock market over the last 5, 10, or 15, 20 years, you're going to see that the stock market continues to make new highs due to a number of reasons. But fill us in on a couple indicators here, and we'll go on to a couple more slides here, Nick.
Yeah, so the reason this is the favorite one is because if this occurs, it gives us conviction that we will have a sustainable rally historically. And breadth thrust, and we have 12 different indicators for breadth thrust. They're rare for markets, so they don't happen all the time. Generally, it includes multiple days of gains, and I'll go a little bit more into that. But we are closing in on the window. Generally, the decline, the amount of days it takes for the decline needs to be accompanied with some type of breadth thrust in the coming back for the market overall. And since this was a pretty fast and quick decline, like that window's closing, and from a historical standpoint, that's like April 4th now. Given that it was in a pretty orderly sell-off, we may not need that exactly, but we're looking for these different indicators to give us conviction. And I will show you in the upcoming slides how that's worked in the past.
Yeah, go ahead and move on, and I'll wrap us up after you go through these couple slides.
Yeah, so hopefully you can see this, but I'll explain it. It's the S&P on the top. All those little up arrows are breadth thrusts. Indicators. And so we have 12 different indicators that we look at, and that Davis looks at. And when we get over 5 out of those 12, we consider that, a strong conviction of a rally. And historically, and you can see they don't happen often. This is going back to 1982, but this has been even more prevalent since the financial crisis. So you can see this is 2008, 2009. In this big decline here, we did not get any breadth thrust indicators, which told us the lows weren't in. And then right near the low, we got several that fired off that gave us more conviction in the market. Same thing with COVID. We got some breadth thrust indicators that gave us more conviction. Same thing after in 2022, when the market kind of bottomed out there, we got breadth thrust indicators that gave us more conviction. So you probably can't see this on the very bottom, but historically, after 5 out of our 12 breadth thrust indicators have fired, 252 days later, which is what 3/4 of a year, I guess, it's been 100% successful, going all the way back to 1980. There's been 28 occurrences of it. The mean up from the bottom was 21.5%. The median was 17.8%. But even on shorter time frames, the mean and median are all positive. Now, there are some that were down in that period of time, but we're looking for a clear and broad conviction. And we may not need 5 this time, given kind of the brevity of the decline. It may have felt really bad for some people, but it was pretty, like I said, pretty orderly overall. And a normal part of market volatility. When our last webinar we talked, we were well overdue for a 10% correction, which generally happens once a year. So it was going to happen at some point.
Yeah, and I think the big thing to look at here is that, looking at data just gives us a better idea of how to bring awareness to what's going on in the market, and taking, headlines and emotions out of it. Obviously, none of these things are perfect, but looking at a weight of evidence approach, from Ned Davis has been a good way to manage risk, and obviously being careful at the extremes.
Yeah, definitely. So here's a couple different examples. So this was take you back to 2018. 2018, Trump was actually doing some tariffs at that time as well. Interest rates were actually rising, so a little bit different environment. But there was a correction earlier in 2018, and they called it, the news comes up with these fancy names, Volmageddon, which was basically was some uh, exacerbated volatility based on options on the VIX, and when their volatility occurred, it kind of exacerbated things. But this was a correction, and after this correction, we did not get any breadth thrust indicators. Now we had a slow kind of grind and a rally here, and a slow grind up, and eventually we hit new highs, but it gave away again to a bigger downturn. So there's no law requiring the market to rally, but a rally, every rally basically of significance since the financial crisis has started with breadth thrust. And conversely, if it did not have 5 of these 12 breadth thrust, it actually was followed by new lows. Um, and then we did going into the Powell mini bear. This was a big decline in a 2 month period of time. So this was a 20% decline. I remember it was Christmas Eve, and I was on the playground with my kids, and people, our clients, were calling and saying, what's going on? Or when was the bottom going to happen? And basically, we had some breadth thrust indicators right after that, and that was the bottom. And that gave us conviction. 2019 was a good year until we hit 2020 was COVID. So that's an example of it. Here's another example in 2022. So we were coming off of record highs in 2021. 2022, we had some corrections followed by 5% rallies, 7% rallies, 5% rallies, but we did not get any kind of breadth thrust conviction until really almost July, August overall. And by October, that's really when it hit. We had 5 out of the 12 indicators, and that was the low of the market in October of 22, which then resulted in a nice bull market in 23 and 24. So these are just some examples of the market goes through a process when these declines happen. It's not immediately corrected, but we do have indicators to help us with, do we have a little bit of an all clear signal overall? So
Yeah. This is a funny slide here. I think everyone can get a little bit of a laugh out of it. Global Economic Policy Uncertainty Index. So if there's a way to confirm, folks' concern about volatility and just really everything right now, this puts this on a chart, right? So talk through that with us.
yeah, so the uncertainty index right here is as high as it was during a global pandemic, which is pretty significant.
Crazy.
And I mean, we look at many indicators, and technical indicators do not occur in a vacuum, but they do reflect a real-time assessment of the market. And as long as the U.S. policy uncertainty index is elevated, the S&P generally struggles. And so if uncertainty is alleviated, generally the uptrend can be more established, but it probably be a choppy uptrend overall. So this is really more technical, and just to give you some things that we're looking at. I think our last webinar was more high level on what's going on with the economy and growth and the Fed, and our base case right now is still no recession, but we're looking for potential entry points, or good sustainable rally opportunities for the market overall at this point as we're going through this process.
All right. Do we want to wrap this call up here, Nick?
Yeah,
All
yeah,
right.
that just short and sweet. I think kind of what I just want to uh, kind of drive in. The point is, ultimately we want to avoid making big emotional decisions, be objective. Don't try to time the market, too much. These indicators are helpful for making small tweaks in the portfolio, making, maybe some adjustments overall, but, on a long-term basis, the market historically has done very, very well, and everyone should have a financial plan, and those financial plans are made to withstand tough markets and bear markets. So, Go back to the plan, with us about your plan, avoid the big mistakes, and just kind of overall trust that plan.
Yeah, I mean, my 2 cents on this, and we'll stop the recording here. But my 2 cents, if you're 5 years plus from retirement, this is a blip in the overall markets, and this actually might, when things go on sale at your local grocery store or BOGO, you go buy those things. So I think that you continue buying your 401k, you continue reallocating to your investment portfolios. And if you're in retirement, this is why we hold different asset classes. If you remember that first slide we talked about, bonds are positive this year. Value stocks are positive this year. And so, just a good reminder that diversification does work during volatility. The big picture, markets are positive more than not, and trust the plan. So, thanks for your time today, and we'll be back soon.